Welcome to Deep Into Finance family. We appreciate you being here with us. Give us a like and subscribe to our channel. Share it with your friends and family. To stay up to date with our future videos, the Federal Reserve's recent decision to increase the federal funds rate by 25 basis points is a significant development for the economy and signals a potential shift in the central bank's monetary policy stance. The federal funds rate, also known as the benchmark interest rate, is a key tool used by the Federal Reserve to control inflation and maintain economic stability. The recent increase in the federal funds rate signals that the central bank believes that the economy is strengthening and that further increases are likely to be necessary in the near future. The Federal Reserve's ability to influence interest rates is a critical aspect of its role in promoting economic stability and controlling inflation. The federal funds rate serves as a benchmark for the cost of borrowing in the economy and affects the borrowing costs for consumers, businesses, and financial institutions. An increase in the federal funds rate directly raises the cost of borrowing, which can have a number of implications for the economy. One of the primary benefits of a higher federal funds rate is that it can help to control inflation. By increasing the cost of borrowing, it discourages spending and investment, which can help to slow down the pace of economic growth and prevent prices from rising too quickly. This is especially important in a strong economy where inflation is a concern, as it helps to maintain the purchasing power of consumers and preserve the stability of the currency. Higher interest rates also have positive impacts on savers and investors. When interest rates rise, savings accounts and other fixed-income investments become more attractive, as they offer higher returns. This can encourage households to save more, which can help to support economic growth over the long term. In addition, higher interest rates can also make investments in bonds and other fixed-income securities more attractive, which can help to attract capital from abroad and support the growth of the domestic economy. The recent increase in the federal funds rate also signals to the market that the Federal Reserve is confident in the strength of the economy and that it believes that further increases are likely to be necessary in the near future. This can help to build investor confidence, as it provides a clear signal of the central bank's intentions and expectations for the future. Furthermore, higher interest rates can also impact the value of the US dollar. As the cost of borrowing in the U.S. increases, it can make investments in U.S. assets more attractive to foreign investors, which can help to strengthen the value of the dollar. This can also help to boost international trade, as a stronger currency can make U.S. exports more competitive in global markets. However, higher interest rates can also have negative impacts on certain sectors of the economy. For example, the increase in borrowing costs can make it more difficult for consumers and businesses to obtain loans, which can slow down spending and investment. In addition, higher interest rates can also make it more expensive for households to refinance their mortgages, which can negatively impact the housing market. It is important for policymakers to carefully consider the impacts of higher interest rates on the economy and to make informed decisions that promote long-term economic stability. This requires a careful balancing of the short-term and long-term impacts of interest rate increases, and a consideration of the broader economic context, including trends in inflation, employment, and economic growth. In conclusion, the Federal Reserve's recent increase in the federal funds rate is a significant development for the economy and signals a potential shift in the central bank's monetary policy stance. The increase in the federal funds rate has both positive and negative impacts on the economy, and it is important for policymakers to carefully consider these impacts in order to make informed decisions that promote long-term economic stability. The Federal Reserve's ability to influence interest rates is a critical aspect of its role in promoting economic stability and controlling inflation, and its recent actions signal that it believes that